All right. Now let's get into costs and benefits associated with owning the underlying asset. Now, so far we've been having a very simple discussion where we buy the underlying asset and we load it up with the time value of money. So we talked about buying an ounce of gold, and we've talked about using borrowed funds to do that, and we were borrowing the funds for 3 months, so we multiplied it, multiplied 1 plus 0.02 to the power 3 over 12, and then whatever the gold spot price was, we calculated the future price. So this was the case when we were just having an asset where there were no costs of storage. For example, here we have not taken into account that, oh, maybe we have to store the gold in a vault or something, right? That a cost we have not taken into account. Or for example, if we were buying a stock and during these 3 months that stock paid us a dividend, so we have not incorporated that. So I will get into the cost of the storage and the benefit of holding the asset. But first, let me just repeat the simple discussion we had, that you take the spot price, you multiply it with 1 plus r to the power t for a stock or a bond or any asset like gold. And we use discrete compounding in this situation and we calculate the future price. And this equation should hold, otherwise the derivative pricing will not be arbitrage free, and you will be able to make a risk free profit, and investors will jump in, and if either this is too high or this is too low or whatever the case might be, they might start buying this, they might start selling this until it comes to a point where it is equal. In the case of a portfolio, or where you have a stock index or an indices, so if you have an index, something like the Nasdaq 100, right, or the S&P 500, or if we talk about other regional markets, let's say India, so you might have the Sensex. So then we use continuous compounding, where you take the spot price and instead of multiplying by 1 plus r to the power t, we multiply with e to the power RT. Now the whole logic here is that if you don't buy this asset, if you didn't buy this stock, if you didn't buy this bond, if you didn't buy this gold, you could have put your money in the bank and earned the risk-free rate, right? So the future price should at least be more than the spot price by the risk-free rate, which denotes the opportunity cost of holding the asset. That if you didn't hold the asset, you could have invested the money in the risk-free rate. So if the investor had not purchased the asset, he or she could have earned the risk-free rate instead. Therefore, the forward price should be at least more than the spot price plus the risk-free rate for the amount of time that the forward is there for. Now let's relax the assumptions and start talking about costs and benefits. So let's say we are talking about gold, and there is a cost of storage that you can't keep it at home, you need to have a special warehouse or a vault for it. So not only should the spot price be more than the not only should the future price be more than the spot price to the extent that it compensates for the interest or the time value of money or the risk free rate, but also if, for example, there is a cost of storage, so then you need to have a future price which not only compensates the investor for the time value of money that they are having an opportunity cost of their funds, but also the cost of storage. So the future value will be greater if the cost is greater of having or holding the asset. Now the situation could be different as well. Let's say we are talking about stocks. Now stocks, there is not a very significant cost of storage. You can almost store them for free. Rather, in some situations, you might even get paid to store them if you have a lot of stocks, right? Number one. Number two, you might be getting dividends on those stocks. So it could very well be the situation that those dividends are more than the interest cost that you're having to pay on the money that you've borrowed to buy the stocks. So then the future price might be even less than what the future price we looked at in the previous slide, that spot price multiplied by 1 plus r to the power t, But because now we've got a benefit of owning this asset, then we will reduce the future price by that much, depending if the benefit is greater than the cost or not. So what we have to see is that if the underlying asset, if there is a cost for holding that, right, and on the other hand, is there a benefit for owning that, and which is greater, the cost or the benefit, and accordingly the future price will be calculated. How the future price is calculated is through this formula, that we take the spot price and we do multiply it with 1 plus r to the power t, but we make some adjustments. The first adjustment we make is we minus the present value of the income. Now this I over here, it stands for income, which is for benefits, right? So even though I use the word benefits, and we have been using the word benefits, but in the formula they have used income, which is I. So interchangeably you can have benefits and income. So first thing we do is we take the spot price and we minus the present value of the income. And if there is any cost of holding the asset, so we add the present value of the cost. So after making these adjustments, that is minusing the present value of the income and adding the present value of the cost, then we multiply this whole thing by 1 plus r to the power t to calculate the future price. Now, and this is the case in discrete compounding. If you were having a case of doing this for an index or a portfolio, then we would use continuous compounding. And with continuous compounding, the concept is the same, but the formula is a little different. What we do is we take the spot price and we multiply it with E. But here what we do is in the numerator of E, we take the risk-free rate and we add the cost and we minus the income. In terms of a rate, that okay, what is the dividend or yield or what is the cost of carrying in terms of a percentage. So we take all of this in percentage and we adjust it in the numerator and then we multiply it by t, and that is what you see over here. So it's a very easy, nice way to actually do it. And in the question you actually get all these details that, oh, the dividend yield of this index is, let's say, 5%, or usually it's much lower, like 2%, and the cost of carry or the risk-free rate is 4%. So what you will do is you will just take 4% and you will minus this 2%, assuming there is no cost of carry for a stock index, because it doesn't really have that much of a cost to carry an investment in stocks. Now what happens is, naturally, if the costs are very, very less and the benefits are very big, so to the extent that the benefit is so big, let's say a stock is paying a dividend and that dividend is so big that not only does it cover your holding cost or cost of carry, which is usually very less in stocks, but also the opportunity cost of capital, that it is, the dividend is more than the risk-free rate, which can be the situation in stocks, right? Dividend usually is more than dividend. Dividend usually is more than the risk-free rate. And in that situation, because the benefit is greater than the cost, you will have something like this, that this is the spot price, and instead of going up, it will be going down, because the future price will be less than the spot price, because the benefit is greater than the cost, to the extent that it's even greater than the opportunity cost. So it is more than compensating the holder of the asset for the risk-free rate. So the future price is going to be less than the spot price. If they are same, if the cost and benefit are same, then they will be equal, and if the cost is greater, then the future price will be greater than the spot price, depending on how much greater the cost is. Let's look at an example. And here we are talking about 1,000 shares of Unilever. The share is for $50, 50 euros. And we are talking about a forward contract for 6 months, right? And the dividend is being paid quarterly, which is every 3 months. So that means during this 6 months, we will have 2 dividends. Then let me just repeat that. We have a dividend which is quarterly, which means every 3 months we are getting a 30-cent dividend. Whereas this future contract is for 6 months. So during the life of the contract, which is 6 months, we're going to get 2 dividends, right? which will be occurring 3 months from now, and then the next one will be 6 months from now. And when we take the spot price, we have to minus the present value of the income before we can, and then the present value of the cost as well, before we can multiply with 1 plus r to the power t. But this present value of the income of these two dividends, you are going to have to calculate the present value, which means you will have to bring one back 3 months and the other one you will have to bring back 6 months, which I will show you in the solution. And we will be discounting based on the risk-free rate of 5%. So calculate the forward price of the forward contract after 6 months. Now let me demonstrate how we do this. First of all, the formula is straightforward. We're going to take the spot price, which is the 50 euros. We're going to minus the present value of income. We're going to add the present value of cost, if any. In this case, there will not be any. And then we will multiply the whole thing with 1 plus r to the power t. Now, the whole complicated part, or the main part in this question, is calculation of the present value of the income, which is these two dividends. So we need to calculate the present value of the income of these two dividends, and this is what is being done over here. That we know the dividend is 30 cents, so they've taken this 30 cents over here, and then the second dividend is also 30 cents, but they are bringing one back by 3 months and the other one they are bringing back by 6 months. So when you say 0.25, 0.25 is basically 3 over 12, 3 months over 12, and 0.5 is basically 6 months over 12. And why it's written in negative is because we are bringing it back, we are discounting it back, because they will be received in the future, but we want the present value of that income. And then we calculate that, so we add them separately and we calculate the present value of the income is 0.5892. So we take the spot price, we minus the present value of the income, and then there is no present value of cost, so we ignore that. And then this whole thing we are going to multiply with 1 plus r to the power t, which you see over here. 5% is the interest rate, so 1 plus r will be 1 plus 0.05, which is 1.05, and to the power t is 0.5, because that is again 6 months, so 6 over 12 is 0.5, and you get your future price like this. Now here we're going to do it with continuous compounding. So now instead of a stock, which was the case in the previous example, it was Unilever stock, here we have a Nifty 50. So this is the Indian stock market index, and since it's an index, we're going to be using the formula where we have e to the power rt, but because we have a cost of carry or a cost of there is a benefit, there is a dividend yield, so as you remember, we will do r minus the cost, add any cost and minus any income, and then this whole thing is multiplied by t. So the rate, or the risk-free rate, is 4. So this r will be 4, and this 2.2 is the dividend yield, which will become the income. And let me show you. So they've taken the spot price, they've multiplied it with e to the power r plus c, cost is 0 in this case, minus I, which is the income, and multiplied by t. So the spot is 15,200, which is where the Nifty is at right now, multiplied by e, and r is going to be your risk-free rate, which is 0.04, and cost is 0, so we can just ignore that, and minus the dividend yield of 0.022, which is the 2.2%, and then we multiply it by 0.25. And why 0.25? Because this is a 3-month forward contract, and 3 month means 3 over 12 is equal to 0.25, and you get the forward price for this contract. Now, when we talk about doing the same thing, instead of doing it for gold or stocks or an index of stocks, if we do it for currencies, it gets a little bit complicated, but it is not that complicated. It's just that we have to understand that instead of taking, this is a special case where the cost of carry is not the interest rate of one currency or the interest rate of the other currency, it is actually the difference between the two. Because now we are dealing with two different currencies, and both the currencies have different interest rates. So what we have to do is that in the cost cost of carry, we actually take the difference between the two interest rates, which is the foreign minus the domestic. So RF minus RD is what we put over here, and it is the spot multiplied by e to the power RF minus RD multiplied by the duration, the time duration. And this is how we get the forward price. Another important thing for us to understand over here is that basically when we talk about the spot price going into the forward price, what are we really focusing on is the base currency. So it involves the purchase of the base currency and the sale of the price currency. So what we are basically doing, and let me explain this with an example. So for example, if RF is greater than RD, which means the foreign currency is having a higher interest rate. Now that's not necessarily a good thing, because high interest rate could mean that maybe they have very high inflation, which means their currency is going to get weak. Now, if that is the case where your foreign currency interest rate is greater than your domestic currency, means this difference is going to be greater than zero, which means you're going to be taking your spot and multiplying it with e to the power RF minus RD multiplied by t. And since this is greater than zero, so your future price will be greater than your spot price. And that is what you see over here, that the future price is greater than the spot price. And since the future price is greater than the spot price, it will be trading at a premium. It will be trading at a premium. However, from the perspective of the currency, because the currency is getting weaker, we will say the foreign currency forward is at a discount. Now, this is a tricky part, and this is something you have to maybe just learn, or if you really want to understand it, then you have to think about it, that sometimes your currency might be, like for example, you might, if you're watching this from India, and 75 Indian rupee to $1 is there, and let's say the next thing we know that it's become 76 Indian rupee to $1. Now you might think that's a good thing because, oh, Indian rupee went from 75 to 76. No, it's not a good thing. It's a bad thing because the Indian rupee became weak. Right? For $1 you could get 75, now you can get 76. So the same way, if the foreign currency is more than the domestic currency, then the future price will be greater than the spot price, and it will be trading at a premium, and the foreign currency forward will be at a discount. And vice versa, if for example the foreign currency rate is less, then the future price will be less, which means it will be at a discount, which means the forward currency will be at a premium. The foreign currency forward will be at a premium. And if it is equal, then neither premium or discount, neither premium or a discount. Let's apply this to an example, so at least we know how to definitely solve the question in the exam. So let's say the Mexican peso, the MXN is the Mexican peso, to the USD exchange rate is 19.5. Now what that means is for each $1 you can get 19.5 Mexican peso. And the risk-free rate is 4%. The 6-month risk-free rate is 4%. The 6-month US dollar risk-free rate is 0.25%. Describe the relationship between the spot rate and the forward rate. Now they've given us the risk-free rate of the domestic currency. They've given us the risk-free rate of the foreign currency, and they want to know what is going to be the forward rate. So first of all, let's calculate the difference between the two, and you can see that that difference is positive because the Mexican peso, which is the foreign currency, is having a risk-free rate of 4%, whereas the US dollar, the domestic currency, is having a risk-free rate of 0.25%. So naturally this is greater than 0, which means the forward rate will be greater than the spot rate. And how do we calculate that? We take the spot rate, we multiply it with e to the power RF minus RD and multiply it by the time, which is 6 months, or 0.5, which is 6/12. And that is how you calculate the forward price for foreign currencies. Now, one last concept before we move to the summary of the entire learning module is convenience yield. Now, convenience yield is similar to the benefit of an asset. This is similar to benefit or income. But when we talked about benefits like a stock paying a dividend, that was in dollar terms, it was cash terms. But sometimes there are benefits of holding an asset which are not really financial. So there are non-cash benefits. So let's talk about oil. That let's say you're holding oil and there is a strike and oil is not available anywhere, and you get the benefit because you had the oil in your storage and you were able to use it. So sometimes what happens is that economic conditions may arise that cause market participants to prefer to own physical commodities, that they realize that there is a benefit of having these commodities in their inventories, right? So for example, crude oil inventories, when the actual crude oil inventories globally become very low, there might be a shortage. In that situation, refineries may bid up the spot oil price so that future forwards do not fully reflect the storage cost and interest rates, which means basically that they like the fact that they are having the storage, and that is what is known as the convenience yield. Especially in times of shortages, this is something that goes up a lot. Now let's look at the summary. The first learning outcome here is the concept of arbitrage and replication, which is used in derivative pricing. And first of all, we talked about identical assets. So we talked about bond A and bond B, which have the same coupon rate, the same face value, but one was trading at 99 euro and the other was trading at 99.15 euro, and that makes absolutely no sense. So naturally people are going to buy this one and people are going to sell this one until they come to the same price. So this is something which is very important for derivative pricing, that one identical asset or two assets which have the same identical cash flows, they should be at the same price, right? Or if we are just talking about one asset, even let's say for example gold, so whatever the spot price is multiplied by the time value of money, which is 1 plus r to the power t, should be equal to the future price. Now this condition should hold as well. So for example, if we have a spot price of 1770 and the interest rate or risk-free rate is 2% and it's a 3-month forward and the future price is more than what it should be, so then there will be an arbitrage opportunity and people will start buying over here and selling over here until they make sure that it comes to exactly the correct amount, which I believe was something around 1787, I believe, but I don't exactly remember. But the point is that this condition should hold, which means number one, identical assets or assets with identical cash flows must have the same price, which is the law of one price. And number two, assets with a known future price must have a spot price that equals the future price discounted at the risk-free rate, right? Otherwise, what will happen is that the replication strategy can be put in place whereby you can buy the asset by borrowing the money. So you could recreate the future by combining a long position, which is buying the asset by borrowing the funds, or selling the asset and lending the cash, right? And if there is a difference in the two, then obviously there will be an arbitrage opportunity, and they will make sure that eventually these rules are brought to the right prices, which is the law of one price. And this is the whole derivative pricing, that it is based on arbitrage free pricing. And if there is arbitrage free pricing, then even if you replicate, then the profit and loss will be the same whether you buy the derivative or you replicate it. There will be no difference in the payoff, which is what we saw in the example as well. Now, the second learning outcome for this learning module is that the difference between the spot and the expected future price has to be not only for the cost of carry, which includes the opportunity cost, but there could be some other cost of carry such as cost of storage, and there could be some benefits of holding the underlying asset. So we need to take into account all the costs and the benefits when we calculate the cost of carry, and that has to be reflected in this formula where we take the spot price and then we minus the present value of the benefits or the income when we add the present value of the cost of carry storage, And then we take this whole thing and then we multiply it with 1 plus r to the power t if it is discrete. And in the case of continuous, what we do is we take the spot price, we multiply with e to the power r plus the cost minus the income yield multiplied by t. In the case of foreign currencies, what we do is we take the spot price multiplied by E, and to the power of, instead of taking R over here, we take both the R's of the foreign currency and the domestic currency, and we take the differential between the two, and then we take that and then multiply it with T, and that is how we get the future price for a foreign currency forward. And that is it for this learning module.